Welcome to The Explainer. Today, we're diving into a really interesting question. What actually happens when one company buys a piece of another one? You'd think you just kind of add them up, right? Well, it's not quite that simple. Turns out it all comes down to one key thing: control. Okay, let's kick things off with a little puzzle. Imagine Company A buys, say, 10% of Company B. So, do you just take 10% of Company B's sales and slap it onto Company A's income statement? I mean, it sounds logical, doesn't it? But nope. The real answer is way more interesting because the accounting rules are actually trying to tell us a story about the relationship between these two companies.
All right, so let's start at the very first rung of this. Let's call it the ladder of influence. This is level one, the passive stake. This is when a company invests, but really they have almost zero say in how the other company is run.
So, when a company owns less than 20% of another one, you can pretty much think of it like the stocks you might own in your own personal portfolio, right? You don't get to call up the CEO and tell them what to do. So, because there's no real influence, the investment just gets reported on the books at whatever its market price is, what they call fair value. It's a hands-off, arm's-length kind of deal. Super simple. Okay, time to climb up to the next level. What happens when that ownership stake gets a bit bigger, say somewhere between 20 and 50%? Well, now things get interesting. This is where the investor actually gets a seat at the table. They now have what's called significant influence. And because of this significant influence, the accounting has to get a little more sophisticated. You can't just market to market anymore. Now we have to use this special set of rules called the equity method. And the whole point of this method is to show that, hey, the investor's choices can now actually affect the other company's bottom line, for better or for worse. And here's the really key thing to understand about the equity method. It's often called a one-line consolidation. Why? Because instead of smushing all the financial statements together, the entire investment gets captured on just one single line on the investor's balance sheet. It's a really clean, elegant way to show the investment's impact without muddying the waters with a bunch of details from a company you don't actually control. Okay, let's make this concrete. We'll pull a quick example from our source material to see how this works in practice. So, let's say Branch Company puts down 200,000 euros for a 20% piece of another company. We'll call them Williams Inc. So that's our starting point, 200 grand. Now, with the equity method, that 200,000 euros isn't just a static number that sits on the books. Think of it as a living, breathing number. Here's how it works. The value of the investment goes up by Branch's share of Williams' profits. Makes sense, right? Williams is more valuable, so Branch's piece is more valuable. But when Williams pays out a cash dividend, the value of that investment on the books goes down because, well, that's cash that's now left the company. So let's play this out over, say, 3 years. Williams Inc. does really well and earns 900,000 euros in profit. Branch gets its 20% slice of that, which is 180,000 euros. So we add that to the investment value. Now, during that same time, Williams pays out 350,000 euros in dividends. Branch gets its 20% share of that too, which comes out to 70,000. And since that's cash in Branch's pocket, we subtract it from the investment's book value. So, you ready for the math? We start with the original 200,000, we add the 180,000 in earnings, and we subtract the 70,000 in dividends. And voila, the new value of that investment on the books is 310,000 euros. All right, we've made it to the top of the ladder, the big one. This is what happens when a company goes all in and buys more than 50% of another company. At this point, we're not talking about influence anymore. We are talking about pure, unadulterated control. The parent company is now running the show. And once a company has control, the accounting rules completely change gear. Now you have to use a method called consolidation. The best analogy is probably moving in with someone, right? You stop thinking about my rent and your groceries. It all just becomes our bills. Same idea here. All the assets, all the debts, everything is combined into one big financial statement. So here's a great visual of the before picture, right from our source material. On the left, you've got Franklin Company, and on the right, Jefferson Inc. Don't get bogged down in the specific numbers here. Just look at the structure. See? Each has its own column for assets, cash, inventory, the usual stuff, and its own liabilities, like debt. Two totally separate companies living their own separate financial lives. And now, the after. This is just a fantastic illustration of what happens next. Franklin buys Jefferson, and boom, we get the Franklin consolidated balance sheet. So what happened here? Well, they've literally just added everything up. Jefferson's cash is now Franklin's cash. Jefferson's debt is now Franklin's debt. It creates a company that looks way bigger on paper. But wait, look closely. Do you see it? There's a new line item here, a new asset that wasn't there before. Goodwill. Where did that come from? So, what on earth is this mysterious goodwill? Well, it's basically a placeholder for the premium you pay when you buy a company. Let's say Jefferson's assets, minus its liabilities, were worth 10 million euros on paper, but Franklin paid 12 million to buy it. That extra 2 million that they paid, that's goodwill. It's the value of all the stuff you can't really touch or count. Things like a great brand name, a loyal customer base, or just a really talented team.
Okay, so we've walked through 3 different levels of influence and 3 different ways to account for them. But here's the big question. Why does this even matter? Why should we care which method is used? Well, as we're about to see, the choice can paint 2 completely different pictures of the same company.
And look, this isn't a trick question. It's not like one method is better than another. The whole point is to use the method that gives the most honest picture of the business relationship. But, and this is a big but, it's absolutely critical for us to understand that those pictures can look radically different depending on the lens you're using.
This slide right here, this gets to the absolute core of it. Just look at the difference. When a company uses consolidation, bam, the revenue, the assets, the debt, everything just blows up. It makes the company look absolutely massive. But if they use the equity method, those numbers barely move. Now here's the real kicker, the part that's so important. Even though the company can look wildly different on paper, the bottom line, the actual profit, is often exactly the same under both methods. Isn't that fascinating?
Now, you might be thinking, well, if consolidation makes me look bigger, I'll just choose that. Ah, but you can't. And this is the crucial point. Companies don't get to just pick and choose the method that makes them look good. The rules are the rules. If you own less than 20%, you're using fair value. Period. Between 20 and 50%, it's the equity method for you. And once you cross that 50% threshold, you have no choice. You must consolidate. It's all about the level of influence, not about what looks best.
And that really brings us to the big takeaway here. The next time you see a big splashy headline, Company X doubles its revenue overnight, I want you to pause and ask yourself, how? Did they actually double their sales? Or did they just buy another company and consolidate their financials? Understanding the story behind the numbers, that's the difference between just reading the news and truly analyzing a business. So is that company with the huge revenue jump really growing, or is it just getting bigger? The answer, as we've seen, is hidden in the account.